Well, good morning, everybody. Of course, there's no shortage of economic data that we could go over as the year-end data for 2024 is trickling in. In the interest of time, we'll highlight just a couple developments that we've been tracking very closely here at RCLCO and that we think will give a good view of where we're heading in 2025 and beyond. One of the notable developments for the year was that the labor market pretty strongly outperformed expectations in 2024. At the beginning of the year, economists came in expecting a meaningful labor market slowdown, even some talk of potential months of negative employment growth. That failed to materialize. Labor growth remained very strong, capping the year off at just over 2 million jobs gained, which is near long-term averages. Another development at the beginning of the year was the much feared recession, which we came in to 2024 expecting at least a shallow recession to take hold. That also failed to materialize, in part due to the strong labor market, which we just touched on, and also GDP growth just remained strong. The Q4 figures just released today. Q4 saw GDP growth of 2.3% on an annualized basis, which is a touch slower than it was in Q3, but still firmly in line with long-term historical averages. And 2024 ended the year with 2.8% GDP growth. So much stronger than was expected at the beginning of the year. Clearly 2.8% GDP growth and 2 million jobs added, not symptomatic of the recession that was feared at the beginning of the year. The other development, of course, continues to be inflation. Headline CPI ended the year down at 2.9%. It had moderated slightly more toward the end of the year and then ticked up at year end, but still represents moderation of about 50 basis points from year end 2023. Core CPI closed out the year at 3.2%. Again, that's a hair lower than where it stood at the end of 2023, although both core and headline CPI continue to run above the Federal Reserve's 2% inflation target. Shelter continued to be the largest contributor to annual inflation. It has slowed fairly considerably over the course of 2024, although the shelter component was later than the overall index to reach an inflection point where it started decelerating, and it still is up higher at 4.6%. So we'll continue to keep a close eye on that. Much has been written about the shelter CPI's lag relative to real-time rent growth, but nevertheless, that continues to be one of the main contributors, the main contributor to the overall consumer price index. The other development then, of course, is interest rates. Some fairly exciting news toward the end of the year. On December 13th, the 10-year to 3-month U.S. Treasury rate spread turned positive for the first time in over 2 years. This is a major development following on September's news when the 10-year and the 2-year yield uninverted. So you can see those inflection points are both circled in red on the chart on the left, showing the U.S. Treasury daily yields. Historically, an inverted yield curve has been a very strong predictor of upcoming recessions. So this chart on the right here shows the 10-year to the 3-month U.S. Treasury spread and has GDP growth and recessions mapped over the top of that. So as you can see, both in the 2001, the 2008, and the 2020 recessions, an inversion of the 10-year and 3-month yields preceded those. And if you extend that history back even further, that tends to hold further back in history as well. The unique development over the past couple of years is that spread inversion has been deeper and far more prolonged than past periods of yield curve inversion. Thus far, as we just mentioned, the recession has not taken hold, and in fact, expectations of a near-term recession have come down fairly significantly. Most economists are below 20% expectation of a recession. So this could very well prove to be a diversion from the historical rule of inverted yields leading recessions. Looking forward, we do expect the 10-year Treasury to remain elevated. Forecasts vary somewhat around this, although most forecasts have the yield ranging somewhere between 4 and 4.5% through the next several years. That's in line with RCLCO's house view, expecting rates to remain elevated for a longer period of time. That, of course, trickles down from the federal funds rate, which in its meeting yesterday, the Fed announced that it was holding the target rate steady in January at 4 to 4.5%. Economists expect 1 to 3 total cuts in 2025, although there's a high amount of uncertainty, particularly around labor market and inflation data in the coming months. As of this morning, futures markets were priced to expect 2 cuts for the year. That's what the Fed's latest dot plot said as well. But again, a high degree of uncertainty depending on data. So this is something that in the real estate industry we'll continue to track very closely.